All right, hi there, everybody. This is trading for direction using volatility improved directional trading, and I will spend I'll spend a little bit of time looking at some earnings if I have time, hopefully here as well. We'll play with IBM maybe or some other names that have earnings today, but I want to kind of give you a lesson on really how to trade, use options correctly for directional trading. For those of you who don't know me, my name is Mark Sebastian. I am the founder of Option Pit. What is Option Pit? We are a group of professional tradings. Combined, our guys and girls have 60 years of professional option trading experience. Andrew, who works with me, was the managing director for a large market making firm in Chicago. Leisha, my director of operations, was one of the first female floor option traders. And then there's me, and I have a general rule of thumb. I only work with people better than me, and both of them are. But I like to think I'm pretty good myself. So Option Pit, we work with retail traders and help them implement a professional approach to trading, which I think is missing from a lot of retail mindset. And if you work with us, it will change the way that you approach options. I can tell you that much. So volatility can act like a headwind or a tailwind. So let's talk about basic buy, sell decisions. I'm going to talk to you about strike selection, and I'm going to talk to you about how to combine buy versus sell and strike decisions to really make a good trade. And I'm not going to do the VIX piece because I want to have time for earnings. So the key to trading options for direction is understanding correlation. Correlation means how one instrument moves with another. A correlation of one means that the two move together perfectly. So a correlation can never be in options greater than 1 or -1. So for instance, there's 100% correlation between me getting slapped in the face and me telling my wife that she looks fat in that dress. That is a correlation. There is a negative correlation between me buying my wife a pair of new shoes and her slapping him in the face. So, needless to say, I need to buy her a new pair of shoes, especially after she overheard what I just said. So delta is the option trader term for correlation. That's not the technical term, but I think it's the simplest way of understanding how options, how we look at delta. In math, it can also be called slope. All right. Delta can change with the passage of time. It can change with price, or one important factor, and this is what screws people up on earnings. All right. And again, we use the term correlation to describe delta. And so an option with a positive 0.6 delta will make 60 cents for every dollar the underlying rallies, and it'll lose 60 cents for every dollar the underlying falls. Really simple. Really simple. All right, so if I own an Apple call with a 50 delta, and Apple goes up $1, my call will be worth 50 cents more, give or take. If Apple drops $1, my call will be worth 50 cents less, give or take. Really simple. So what makes delta hard is that it can change on you. So I buy 100 shares of stock. Guess what? In a week, it'll be 100 shares of stock. In 2 weeks, it'll be 100 shares of stock. In a year, it'll be 100 shares of stock if I don't do anything with it. All right. That is not the case with delta. Delta can change, and so think about it this way: I buy a call option that has a year to go. All right, so like Facebook. Facebook's trading $165. I buy a call option at the 200 strike that has a year to go. Guess what? It's going to correlate to the underlying sum. What about that 200 call when it has a day to expire? Is there any chance that's going to end up in the money? No, not at all. All right. So that's the thing to understand, is that the greatest thing that can affect delta, though, it can change on you, is volatility. That change in volatility will kill you. And this is going to be kind of how delta moves with stock. So the blue line represents delta, and the green line represents the stock. This is the strike price. This is the strike price here. And this is the price of the underlying. All right. So as the stock goes up, the delta correlates more and more to the underlying at expiration. So has this happened to you? And I know we've all heard this as market makers. Mark, market makers are cheaters. Yes, I bought all these calls right before earnings. The stock is way higher, but I'm not making money. Those dirty market makers stole my money because they lowered the price of the volatility, because they lowered their option prices. Yeah, us dirty cheating market makers. And the answer is no one took your money. The inputs of the model that priced your option changed. The delta of your option changed. You thought you were long a bunch of options. You thought you were long all this exposure to the underlying, but you weren't. You weren't. All right. And I can show you this real fast. We'll power our way through this, folks. So let's look at Netflix. Netflix is up $25. All right. And this is, here we are looking at Monday. So this is the night before earnings. I'm not sure why this is moving. There we go. So this is the night before earnings. They've got their dates crossed. All right, so here we are the day before earnings. This date is wrong, but it doesn't really matter. We'll go to the April 20s. So I buy I'm like, I think Netflix is going to blow up earnings. They're going to do great. And I buy the April 350 calls for $2.70. All right, so 267, 275. I get a good fill. I pay 270. All right, so here we are the next day. Netflix is up $25. That's a huge move. What is the value of my April 350s? They're 68 cents. So what happened? Well, you can see what happened. You can actually see the green on this screen. The middle is my theoretical price from yesterday, and here's what they're pricing now. So what changed? Take a look right here. This number here is IV 42.9. This is the volatility that my theoretical price was derived from, 68. The volatility changed. Why is this giving me trouble? There we go. All right, the Greeks, including delta, are produced by a pricing model. They are modeled risk. They are meant to help traders manage the risk of a position. They're not a hard number. All right, a hard number, right? It's not like stock where 100 shares of stock is 100 shares of stock. Delta is not fixed. There is an old term in data called garbage in, garbage out. And if you put in bad theoreticals, you will get garbage pricing. So since delta can change and is a modeled risk, picking the right option for the direction is key. Should an option be bought or sold, in the money, at the money, or out of the money? It all depends on what your forecast is for implied volatility. Is implied volatility going to go up or down? All right, so what makes it different? What makes option trading different than stock trading? The answer is implied volatility. All right, implied volatility of a stock or index is going to go anywhere, but it can't stay there. And we don't know where a stock is going to go. There's a mean reverting characteristic. So I want to show you this. This is Apple stock. This is an old chart, but I want you to look, right? It's kind of nonsensical. If I pull up a chart of, Micron, here's Micron. There's a 2-year chart of Micron. Does that appear to have any pattern to it? The Elliott wave people say, oh, there's a clear pattern. Well, take a look at this 50-day moving average. It's going straight up. Take a look at 200-day moving average, straight up. The only pattern is up for Micron. Now, this is VXAPL, and that is the VIX of Apple options. And what do you notice? Take a look at that. That gray line here is the 200-day moving average. It's not going anywhere. It's not going anywhere. So, kind of crazy, but that mean reverting characteristic is what drives trading of options. If there was not a mean reverting characteristic to options, it would be impossible to be a market maker. So a stock price can go anywhere and stay there. Volatility can go anywhere, but it can't stay there. It will revert back over the time. And understanding that will help you with buy and sell decisions. So let's talk about buying and selling. In general, when implied volatility is low in the near term, and especially in the long term, the play is that it can make sense to buy instead of sell. So in 2017, as volatility was at its lows, the VIX was in the 9s. It was so easy to buy call options because they were so cheap and the underlying just kept going up. And if you wanted to hedge, it was dirt cheap to buy puts. When IV is high or normal, so when in a regular vol environment, historically at the mean environment for implied volatility, I'd rather sell. And when volatility is high, a lot of times I'd rather sell. So when you want to go long, there's 2 ways to get long. I can sell puts or I can buy calls. All right. Each trade acts very differently despite being long the underlying. So a short put is long delta, so it gives you that long exposure, but it's something called short vega. Now, what is vega? Vega is how you are exposed to implied volatility. If I have a short Vega position, I want implied volatility to drop. Now, what makes implied volatility drop? What makes implied volatility drop? Well, two things. Movement drops, HV. HV stands for movement. Movement drops, or the expectation of movement drops. So from a mindset, and this is key, all you put credit spread sellers, all of you put sellers, when you sell a put, you don't want the underlying to go up. You want the underlying not to go down. There is a difference, right? There's a difference between, in hockey, I don't know how many people are here are hockey fans, but in hockey, there's a difference between trying not to lose and winning. When a game is tied, near the end of the third period, both teams are playing not to lose because they want that point. Then in overtime, they play to win. All right, so when you're playing not to lose, that is when you're selling puts. You're betting that the underlying won't go down. Here's a nice little JP Morgan one from a while ago. And actually, I would look at a JP Morgan one now. This is one we actually did in our chat room. All right, pull this up. Let's take a look. Stock gets slammed on earnings. The implied volatility, this red line, the implied volatility is still high. It's 24 when it's probably going to 18. So what did I do? I did the April 110-108 put spread. I sold it at 55 cents. It's 30 now. I'm going to drop a 21-cent bid in there. That is what I'm doing. All right. JP Morgan was getting smoked. I said to myself, it's not going to go any lower. Might not rally, but it's not going a lot lower. Touched 110. I know. Touched 110 and has stuck between 110.5 and 111 for the last 2 days. I'm going to cover my put spread that I sold at 55 cents for 21. You just saw me drop the bid in. All right, so now what about a long call? What's a long call? Well, I think the underlying is going to go higher. The trader is hoping the underlying goes up and vol goes up, movement goes up. So what makes that movement happen? Either what makes implied vol go up? Either an expectation of movement or an actual increase in movement. All right, so what are some areas where I like long calls? Well, here's a good example of Alta. The implied volatility got super cheap, and the underlying went straight up from there. It was a perfect call purchase. More recent, if I was going to look for some things, we looked at Lululemon. There's one, Keith, that does the breakout bulletin. He put this one in. I did it in SPY. Bought these for $1 yesterday. All right, why? Because I thought the underlying was going to move higher. And we did. Wow, they are smashing vol. And they are running this market higher. All right, so now getting short, very similar. When IV is high and one thinks the stock is going to go down, or not go up. Sell calls are a call spread, typically a call spread. When implied volatility is low and one thinks the stock is going to fall, you buy puts. Pretty simple. Short calls, IBM has been a credit spread seller's dream for umpteen 2 years. All right, if I pull up, IBM has earnings tonight. We'll look at it in a little bit. But I mean, take a look at a chart of this thing. You know, it had a nice little touch of 170, but really, if you look at the last 2 years, outside of a kind of a period here where you wanted to stay away, you could basically sell the 65-70 call spread like clockwork. You just had to have a little risk management in over the last, you know, over this period here when we went straight up and they faded it. I don't know why this is giving me a hard time here. LiveVol does not want to seem to go to the back screen here all of a sudden. Have to shut it down again. And then here's one where we bought a put. One second here, folks. I don't know why this is giving me garbage. I don't know why this is giving me a, why is this, did this stop, come on. I think PowerPoint has locked up on me, folks. Nope, here we go. Now it's working. Unbelievable. All right, sorry. So here we go. Here's a case where really this was, remember IBM had that just terrible earnings call right here. And after it dropped, they murdered the volatility. I mean, look, it got down to about 14. All right, when you hit like a, and I'll talk about this, when volatility gets really low and the underlying is falling, you want to buy puts. Why? Because it basically means that nobody cares. They're selling the stock instead of hedging. So the next step to understanding whether you want to buy or sell is thinking about strike selection. So what I want to talk is hard or soft delta. All right, so a hard delta is something stable, and that's more in the money. So with Facebook 165, a harder delta is going to be like a 165 call, or excuse me, a 160 or a 155 call, or a 175 put. A softer delta would be like the 170 call or the 175 call. It's an out of the money call. And why? Because a soft delta has sensitivity to implied volatility, right? You buy those out of the money calls or out of the money puts, they're very sensitive, price sensitive to implied volatility. So yeah, kind of the same thing, right? Soft deltas are out of the money and far out of the money. Hard deltas are in the money and at the money. So when would one want a hard delta? When you think implied volatility might fall and you don't want to sell. All right, when IV is very high. So when IV is crazy high, selling options is kind of scary. So if you've got a directional opinion, that's actually the time to think about an in-the-money option. So, you know, that's really the key. So here's Goldman, right? Goldman, it's low, but the implied volatility is really high. But I think it can make a strong move. What do I want to do? Take a look. So I can buy the 110 calls, or I could buy a bunch of the 125 calls. I don't know how much time we have, so I'm just going to show this one example. We can see a couple days later, my 110 calls are worth $3 more, and my 125 calls are worth 20 cents more. Not terrible. So here's what I want to point out. If I bought one of those 110 calls, I was paying $7.60, and I was buying 70 deltas. If I bought 8 of those 125 calls, and yes, this is an old example, but it's very apt. All right, for 96 cents, I would spend 768 bucks. All right, so on the 23rd, so 8 days later, the stock's up $5. My December 110 calls are now worth $10.65. I made a $3 profit. That's 305 bucks for a 1-lot call. Those 8 calls that I bought that had all that delta, I only made 184 bucks. Why? The vol dropped. Look, the implied volatility dropped significantly. See that? 4 points in the 125 calls. So despite the fact I spent less, bought fewer contracts, I made more money. And a soft delta is an out of the money. And the time you use soft deltas are when implied volatility is really low and you're looking and you're looking for a low vol move. All right, you're looking for a low vol. You're looking for a move, but vol is really low. And I'll show you one here. Here's IBM. It's in the toilet. Implied volatility is in the toilet. DC85s, DC95s, 680, 120. A couple days later, you can see, not bad, right? They both made money. Well, what did better? Well, I paid $680 on 1 call. I spent $610 on 5 calls. A couple days later, the stock's up $3. Look how much better I did. I made more than double on my out of the money calls than my in the money calls. And why? Because we got a quick move and vol rallied. Very simple. You know, I don't think you can buy, even a 60 delta is fine for a hard delta. All right. So here's what I want to point out. the two trades that I love, and they actually have these scans. If you own LiveVol, all right, if you use LiveVol, the scans are right in there. If you don't, you can still do this because TD has implied volatility. Almost everybody does. When implied volatility gets to a 52-week low and a stock is right near its 52-week high, buy calls. I do this trade all the time. It works. Here's Goldman. Implied volatility super low. Stock just off the recent high. Or right here, it's even at a high. Right here. Right here. And right here. Stock blows higher. Vol blows higher. Calls killed it. Here's Tesla. Similar trade. Trade 2, when that IV or VIX methodology hits a 52-week low and the stock hits a 52-week low, buy the second put out of the money. Why? Sinking IVs and sinking stocks means the stock is going lower. Gold did this a while back. Vol low. Stock was at a 52-week low. Guess what? It tanked. Vol went up. All right, so I will look at some earnings. I want to make a quick offer to you guys. Last weekend, we did what amounts to an amazing 4-hour presentation on trading weekly options. All right, we had Andrew, who's my chief operating officer. He did a breakdown on really the structure of weekly options. Then he traded weekly calendars in detail. Then Keith came on and did a heavy dose of directional trading with weekly options. It was great. Then I did butterflies, short butterflies, and I touched on earnings. I was April 7th. Now, it's currently in our store for $297. So if you want, you can go to our store and buy it for $297. However, if you go to optionpit.com/weeklies, so not on the store, you can have it for $147. Now, here is the special deal I'm giving you guys. All right. If you use the code CANDLE70, so you go to optionpit.com/weeklies and use code, send that to all. So optionpit.com/weeklies, and then you use code CANDLE70. It'll take $70 off the price. So only $77 plus I'm going to give you 1 month of access to our chat room for free. So that is a $500 value for $77 to steal. All right, do I have time to look at an earnings play, or are we running, or am I running short, Renee? I think I've got time. So I think we've got time to look at one earnings play. Who wants to look? Someone throw out a stock they're interested in around earnings. And Renee, interrupt me whenever. Goldman just had earnings this morning. How about, all right, IBM or AMD? You guys, which would you guys prefer? AMD's kind of interesting. $10 stock, inexpensive play. Let's take a look. So the first thing I do is I'm going to look at a kind of a near dated chart. And I'm going to go out and just say that given where earnings are, premium doesn't seem that expensive. I would say it's about normal. If anything, it's cheap. If I look at the term structure, you can actually see where earnings are. Take a look. They're definitely next week. Yes, yes, you will. That will be included. So if we buy in, we'll be able to watch the video from last weekend. Yes, you will. I'm looking at AMD right now. I haven't decided yet. So AMD, I want to look at the historical. I'm going to look at like some historical stuff. So it's typically done pretty well on their earnings. This is a mover. So this red line represents the near dated straddle. And you can see it's only been lost once in the last 4. So as I look, I'm seeing some wings that are really expensive. So, and a straddle that's pretty cheap. So I can buy the 10.5 straddle for about $1. You know, if you look, the last earnings, it made a nasty move. I don't know that I want to buy next week because I want a little bit of time. So I might go to the following week and look at the 10.5. That's only going to cost me 14 more cents and 13 more cents, and I get an extra week. So I buy the 10.5 straddle that expires May 4th, and then I would probably sell. I mean, I get 18 cents for the 11.5s and 15 cents for the 9.5s. So that strangle, so I can sell the earnings strangle and buy the earnings straddle, and it's cost me 81 cents, and it's $1 wide. I think I can do extremely well on that. I know it's a little more complex, but you're saying, Mark, how about something a little simpler and easier to understand? Fine. I think it's going to go up. All right, they've got a lot of reasons to go up. The pattern seems to be it's finally found a base. And really, from $10, how much lower is it going to go? This is called live vol. The straddle is pricing itself $1. I like to price my long option within the straddle. Within the straddle. So that means I want my long option at within 11.5 and 9.5. Well, the cheapest option on the board is the 11s. So I would buy the 11s. And then I would sell the 12s. And I'd buy the 13s. So I would put on what's called a bullish butterfly. That is 50 cents out of the money. And it looks like it's going to cost me 15 cents. So I'm betting 15 cents 10 times, $150. And if AMD moves, goes up, I can make as much as 85 cents. So do I think that sellers have an inherent advantage over buyers in options? I do not. So here's the thing to think about, especially with earnings. I'm going to give you two statements, but they mean very different things. All right. Statement one, and this statement is true. If I sell options on every earnings, more often than not, the trade will make money. So if I sold 3,000 earnings spreads, more of my earnings spreads would win than lose. That is a true statement. Here's statement two. If I sell every earnings, all right, on the whole, I will make money. And that statement is false. Why is that? Well, yeah. Well, when a short option loses, statistically on earnings, it loses a lot more than they make. So the SIBO, this is an unpublished study, but my friend Russell Rhodes and I had a deep conversation about this. They ran a study over like 10 years of earnings, and Alicia, you'll find this fascinating. They ran a study of like probably 25,000 earnings straddles. They sold or bought every straddle. And you know what they found? Both positions lost. You know how much they lost by? The bid-ask spread. So statistically, buying options loses. Statistically, selling options loses on earnings. So my general belief is if I don't generally trade earnings very much, my general belief is if I'm going to trade earnings, I have to have a real outlook on either volatility or on the underlying. If I don't have a really strong opinion, I do not trade it. I'd rather trade it before it and get out. And I love trading after. After the news is out, I love trading earnings. There's money to be made on that. All right. So any other questions? I think I'm about out of time. In fact, I know I'm out of time. So again, go to optionpit.com/weeklies, WEEKLYS. Use code CANDLE70. And you get this awesome weekly options course and a month of Option Pit Live for $77.